The housing market is hot right now if you haven't noticed. Over the past decade, house prices have gone up a lot, and recently they've gone up a really lot. When house prices go up, equity is created. What is equity? Equity is the difference in what you owe on a property and what it's worth. So if the value goes up, you're gonna be paying your mortgages every month, so that's gonna go down a little bit, but as the value goes up, you create more of that equity. Great, Sam, I have equity. What do I do with that equity? So there's kind of three main things that I think you can do with equity. So if you own a house that you live in or you own rental property, your equity's gone up a lot. Let's talk about what you can do with it. The three options are do nothing, cash out refinance, or do a HELOC or home equity line of credit. In this video, we're gonna talk about the third one. A cash out refinance is simply when you tap into some of that equity and pull it out as cash. So if you have $200,000 equity in your house, you can pull out, let's not get into the details, you can pull out $50,000, $60,000, $70,000 maybe in cash. So you have it as cash. It's not taxed because it's debt that you're pulling out, because that 50 or 60 grand you pulled out is going back onto your mortgage. That's not what we're gonna talk about in this video. We're gonna talk about an option that gives you a little bit more flexibility. Let's talk about a HELOC or a home equity line of credit. Think of it like a credit card, and the limit is the amount of equity in your property that the bank feels comfortable lending you. Let's do a quick and simple example. Let's say a few years ago you bought a house for $100,000. Simple math, and now it's worth $200,000. Your equity went up at least $100,000 because you probably paid down the mortgage a little bit, but let's not worry about that bottom line. The bank will send out an appraiser of some kind to give a value on that property. And if that value of that property is indeed worth $200,000, the bank will let you pull a line of credit, or kind of like a credit card, on some of that equity. They feel comfortable doing that because that credit is backed by actual equity in a property. On a standard HELOC, on that example with the standard HELOC, let's say you have the house that's worth $100,000, you owe $80,000, so there's $20,000 of equity. It went up to $200,000 in value, which a lot of things have done recently. Prices have gone up a lot. So now you went from $20,000 worth of equity to $120,000 of equity, and that's what you're gonna tap into. Most of the time, bank will lend 80% of what the property is worth. Just like they did on that original purchase for $100,000, they lent you 80. On this, it's worth $200,000. 80% of that is $160,000. So they'll probably give you some type of line of credit for the difference between $160,000 and what you owe on the property. Because if you take it all out, there's still equity built in. HELOCs are awesome because you can use it for whatever you want. There is no limit, there's no rules to what you can use that home equity line of credit if you're deciding to use it. You usually have to pay a little fee on the front end, but nothing crazy. When the money is being used is when you are charged interest on it. You don't get it for free. But if you're not using the money, you're not paying anything. That's kind of one of the biggest difference between a cash out refinance. You're pulling it out as cash, which is awesome, but you're paying interest on the money you pulled out because it's added to the mortgage. On a HELOC, you're not paying any interest on the money you use unless you have it pulled out and are using it. The interest rate they charge you is usually some form of the prime interest rate, which does fluctuate up and down, but it's usually pretty low. Right now, you can probably get a home equity line of credit for anywhere from 3 to 5%. Interest only, and it's only charged when you're actually using it. So if you pull out $10,000 to buy a new dining set, interesting way to use $10,000, but that's what you wanted to do. You took $10,000 out to buy a new dining set. They're going to charge you that 3 to 5% interest only until you pay it back. Now let's talk about some pros and cons of HELOCs versus cash out refinances. A huge pro of having a HELOC is you can access the money when you need it and put it back when you don't. It's a super cheap, inexpensive way to borrow money. Shoot, with inflation, the inflation is higher than the actual interest you're getting, so it's kind of like free money. To kind of hammer that down a little bit, inflation right now is probably 6 or 7%. So if you're pulling money out and paying 3 or 4%, you're actually getting that money for free because anything you would buy with that money, assets or most things, are going to go up in value more than the interest you're actually paying on it. Another pro would be it's extremely liquid, meaning usually within a business day or two, you can get access to that money. The main and only con of having a HELOC is it's a variable rate. It will go up and down with prime rates. If you have noticed at all or read the news at all, interest rates are going to go up. The Fed is raising interest rates slowly, but they are raising interest rates this year and probably going forward for a little while. So that money is going to cost a little bit more, but it's still pretty cheap. Let's talk about cash out refinances. The main pro of a refinance is it's a locked rate. You're adding money to your mortgage as long as there's enough equity that the bank is comfortable with, and you're pulling it out as cash, so it's yours, and it's at a locked rate. It's just like your normal loan right now, probably 30-year locked rate. So the interest rate's not gonna go up or down as the actual interest rates of the current market fluctuate. Some cons of refinances are, once it's out, it's out. You can't really put it back in. You pull it out, you gotta use it, or it's just sitting in your bank account. And with inflation right now, it's actually losing value. If you're gonna pull it out to just have it sit in your bank account and you're not gonna use it, that would be a misuse of a cash out refinance in my opinion, because it's losing value every single day. If you're gonna pull it out and put it into something long-term, that's when a cash out refinance might make a little more sense than a HELOC. Also, it's usually a little bit more expensive to do a cash out refinance. The appraisal process is a little bit more in depth and usually costs you a little bit more money upfront to do the process. When should you and when should you not exercise a HELOC? I kind of alluded to it earlier, but I would not exercise a HELOC if you're gonna put that money into something long-term, because like I said, that rate can vary. If you put it into something that's not gonna give you money back right away, or that you're gonna have to have it out for a long period of time, that rate can and will probably go up and down, and probably over the next several years will go up. So that money is gonna get more and more expensive. I prefer HELOCs if it's something that you're gonna get paid back in 6, 12 months, maybe a pool or a dining room set, or kind of redoing a portion of the house, maybe your kitchen, whatever it is. If you're planning on paying that back with your active income or with whatever you're buying produces over the next 6 to 12 months, I think a HELOC is a great option for you. Now, there are rules and regulations that go with lending money, but I do know people that have pulled out HELOCs recently and they have it at 3 or 4%, and they're lending it out to other people to invest or do things with, and they're charging them 10 to 12%. So they're making that arbitrage, that difference in what they're being charged and what they're charging, and as long as they're lending it out on a short-term basis, you can make a little money on it. I think pulling out a HELOC to help you fix and flip a rental property, maybe use the HELOC money for the down payment with the hard money lender, or the monthly payment to the hard money lender, or use it to pay for a rehab of a project or portion of a rehab project, is great, because hopefully if it's a fix and flip, it's quick, you're in and out, and you're gonna get it back. So it can help your investments in that way. I would not probably pull out a HELOC to put 20% down on a rental property, because it's gonna take you quite a while to get cash flow enough to pay that 20% back, unless you have another form or way that you're gonna pay back that 20% that you pulled out on the HELOC faster. Some people call that a bridge loan. If you pull it out for a short period of time and you have some other flip that's finishing or some other influx of money coming in to pay it off, then it's okay. But kind of like the whole theme of this, HELOCs are for short-term investments or short-term purchases, in my opinion. You can see that HELOCs can be an extremely powerful tool. If you're utilizing them correctly, you can do a lot of things that you couldn't do. And if you decide to change your plans or not use it, or something falls through on the investment or the purchase, you don't have to use a HELOC, so you're not being charged any money. That's a great reason to use it. Which one is best, HELOC cash out? I think it really depends on what your exit plan is and what you're gonna do with that money. Regardless, I would suggest doing something with the current equity in your property, whether it's your rental property or whether it's your primary residence. If you don't know what you're gonna do with it, I would look at opening up a HELOC, talking to your bank. They'll gladly get you started in it. If you don't know what you're gonna do with it, take advantage of the equity you have now. If you do have a plan for it, maybe the cash out refinance is best for you. If you wanna learn more tactical things about how to invest and how to buy rental properties, check out this video above where I walk through how to buy rental properties using other people's money. It's a good one. If you enjoyed this video at all, give this video a like, hit that subscribe button, notification bell. See you on the next one.